What? Sorry about
accessing this Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, episdoe, nor its affiliates, nor any of the respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, fantastic. So how's everybody doing today? Good? Let's see how our index is looking. We've got, let me get rid of this thing, which is in my way that you probably can't see. Okay, cool. All right, so we have we sold off a bit. I was just saying to the members in the chat room. The Dow's up 154 points, but Boeing is up like 20 points. So let's see what Boeing's doing at the moment. Oh wait, it's a bad place for that. Hang on, can I find a good spot for this little thing? So Boeing is a Dow component, of course, and it's up 18 points. 18 points is 150 Dow points. You know, it's 8.5 points per dollar. So, you know, and that's why the Dow is such a stupid index. Because for each dollar a component goes up, the index moves 8.5 points. But that makes no sense because well, I don't have a thing of the Dow. That the weighting of it is all screwed up. DJI, because the lowest, you know, so in other words, the lower price companies in the Dow don't matter because they can't make a significant move. So here's the Dow today, and Boeing, it's not alphabetical, of course. Why would it be alphabetical? Then you could find stuff. Boeing, there it is down at the bottom, because it's a B. Boeing's up 5.27%, but that's not really the point. It's up 17, 18 points. You know, Merck is down 2.5%, but it's only down 141. So Boeing up 17 points, $18, compared to that being up 14. It's up 10 times more. It has, and since it's up double, it has 5 times more FET than Merck going down. So Boeing going up is having 5 times the positive influence that Merck going down has. And I'm sorry, Johnson & Johnson. Merck is a different thing. So, you know, these are, you know, this one's, well, they're about the same, really. I mean, this is double the amount of the move. So Johnson & Johnson is a heavier weighted company, but still it's a lower price move and makes less of an impact. Pfizer, of course, doesn't matter what Pfizer does. It's only a $37 stock, so who cares what it does? It has basically no effect on the Dow. Boeing is getting ridiculously outsized. So is Apple, though. I mean, Apple's Apple's only 166. Sorry, I take that back. Boeing has just become completely outsized. So now the Dow is a Boeing index. There's no component on the Dow that's much more than half of what Boeing is. Goldman Sachs is the only one. Goldman Sachs and 3M are over $200. Everyone else is much lower. And look, anybody who's $50, $40, GE is $16. Well, GE can't move the Dow. If it doubled, it wouldn't move the Dow as much as Boeing is moving the Dow. If GE went up 100%, it wouldn't move the Dow as much as Boeing moving 5%. That's why it's a stupid index. So, but anyway, so the key takeaways, without even bothering to analyze it, you can see some guys are down and some guys are up. It's a mixed day for the Dow, and Boeing is basically 100% of the Dow's net gain today. So you have to take the entire move with a grain of salt. We talked about the levels and what we expected to see and the bounces and so on and so forth earlier. But now you have to take into account that this whole thing is skewed by Boeing. So, and of course, obviously, Boeing brings up the S&P as well, because it's an S&P component. It's not a NASDAQ component. That's doing it on itself. But those indexes are going to follow. When the Dow jumps up and the S&P jumps up, the other indexes are going to go up just because people are like, oh, well, it must be a rally. And they start buying. Speaking of rallies, look at gasoline go. Wow, they weren't happy about being at 185. Anyway, so I should have started with that. I already picked I only bought one, but I mean I took a long on the Russell because the Russell hit it hit 1580, when I was like, well, 1580 is a good spot to play long. It's a nice round area, and it was a good spot to play long over here. So I added one. I was hoping it would dip below 1580, but it didn't, so it's already up $90. So I'm not advocating chasing it. The Dow, though, you can play right now at 2602. Same thing, just play with tight stops below. So let's do one of those. I'm sorry, 26,200. Oops, didn't work. Come on, let's see if it comes back down. Nope. Ah, you bastards. Made me angry. Anyway, in theory, you could play the Dow over here. Basically, you got to cross on the S&P. Oh, by the way, when you're making an entry in the futures, you can see you're going to hit resistance right here. Even it doesn't matter that you buy this one. You're going to hit resistance when the S&P hits its resistance. Everybody's going to hit some resistance. So you have to know it's going to be a pretty short trip until you see the S&P confirm above that line. So you can't get too excited about it. But still, oh, here he comes. Now it's back. So 2603 I'll take over there. And just to be even with everybody, I'm going to take this one off for now. Thank you. All right, so now I just got the one that I'll worry about. I'm not going to worry about two things at a time. So I want to see this guy clear 2830. I want to obviously make sure the Russell holds 1580. And I would like to see the NASDAQ get back over the 75 line. That's probably not going to happen, though. The NASDAQ's going to hit 75 at the same time that the S&P is going to hit 32, assuming it goes up in the first place. So given that, I'm not expecting much of a move out of the Dow, maybe 25 points. So figure I'm looking for like $100 on this thing at best. So you have to be aware of that when you make the trade, because if I'm only going to make $100, my risk shouldn't be that high, should it? I shouldn't allow myself to lose more than $50 because I want to make sure I have a positive risk-reward ratio. So if it keeps going down, I'm going to get out of this thing. And how much is $50? That's going to be 10 points. It's not far. So 93 down here. So effectively, that would be my stop. But I say that, but it means I'd still be looking to see what everyone else is doing to see if I think it's a legitimate move. And look how fast it hits it. But anyway, you have to, so like I said, though, everything in the Dow, though, it's just all about Boeing. But the thing about Boeing, they had great earnings. There's no reason to expect them to pull back. So there's a built-in 150 push on the Dow. So the rest of the Dow is flat at the moment. It would take the rest of the Dow would have to suddenly decide to go down, even though Boeing is up so much, and even though the other indexes are up. It would take a pretty big setback for things to go down. Now we got the Fed coming up in an hour, and that's a complete wild card. That can go either way. So I'm just messing around right now. I'm not inclined to take any bets into the Fed because we don't know what the hell they're going to do. And we don't know how the market's going to react because it's gotten pretty out of hand. I'm going to just leave that, though. I think I like the position right now. I want to see if we have a little bit of a rally into the Fed. First of all, the Fed has not caused a sell-off in ages. So there's likely to be some positioning long ahead of the Fed, which we'll watch. Let me guess. Too late. I was going to make it even so I could be at 6,200, but it's I wouldn't get there if I had now. Oh well. Okay. What else? Let's see if we got immediate questions, and then we'll move on. Oh, I want to get to the new trades. Can I get a call-in number? Is there such a thing? I don't know what a call-in number is. BA so disconnected from reality or not? I just wrote that up, in fact, Winston. In chat, I wrote up, so what I said. Let's see what I said. I think it was brilliant. This is not good. I can't get to my little elevator thing. There it is. Above this, I have a block of the webinar control panel that you guys probably can't see. Boeing. We just talked about them. Grubhub. No, it's before that. I know. Control F, B, A, / Nope. Damn it. $40. I know it was 40 times earnings. There it is. Haha. All right. So what I was saying was, all right. But first of all, Boeing just announced they're buying back $9 billion worth of stock. So they're buying back 5% of their own stock. So that's why they're up 5% right now. Take the regular value, add it, because the beat was expected. Now, my objection to this, though, is BA at 357 is a $213 billion market cap. They only made $5 billion last year. So that means it's 100 times earnings. No, sorry, not 100 times earnings. Sorry, 40. It's 40 times earnings, 100. It's 40 times earnings. That's way too much for an industrial company because, look, how many years will it take them to get to 40 times what they're, to get the earnings down to 20? Let's say 20 is reasonable. And 20 is not, 20 is generally generous for an industrial company. We're going to call that reasonable now in this market, because if something is 20, you consider it a good deal in this market. So they have to double their production. How many years of growth will it take Boeing to double their production? That's what you have to take into account if you're going to pay 40 for something. Is it really something that's going to happen in the next decade? And more importantly, is it going to happen before there's a recession? So let's say even at 20% growth, it'll take them at least 4 years to double their revenues and double their profits. And they're not growing at 20%. They're probably growing 10%. Well, let's take a quick look. I believe I looked and said they were flat. If I remember correctly, they're generally flat. Boeing, yeah. Look, 5.4, 5.2, 4.9, and this year quarterly. Math. $6 billion. Let's say about $6 billion, assuming it carries through. So now they're at $6 billion, but that's not really different than it was. They were at 4.9, so they're up about 20%. So this is a good year, but it's only, really, if you look at it over the longer term, they're not growing that fast. They just happen to have this year as a good year. So I said about that, if they have $9 billion to throw around on buybacks, and their business is so great and it's going to grow 20% a year, why wouldn't they just hire 15,000 people, which would be 10% more people than they have now, open a new plant? We know that Tesla spent $2.5 billion on a gigafactory, so I imagine a new Boeing plant's got to be roughly in the same ballpark, $2.5 billion. and they spend, and let's say all these 15,000 people make $100,000 salary a year. That's only $1.5 billion. 15,000 times 100,000 is 1.5 billion. So that would total $4 billion, and they could increase their production by 10%. And if it's such a great freaking company, and they can increase their production by 10%, why wouldn't they do that? Why on earth would they be opening? Why would they, instead of opening up a factory and hiring more people, would they be buying back their own stock? And you know, it's not because they flipped a coin or they looked at a magic 8 ball and one said buy stock and one said open a new factory. It's because their modeling tells them they're not going to grow at 20% a year for the next 4 years. It's not worth it for them to buy a new factory. They know what their orders are like. They know what their ability to fill is. And by the way, something people don't understand about Boeing and a lot of companies people don't understand this about. You can't just open a new factory because the people who give you parts would have to open new factories too. If you're going to make 10% more planes, you need 10% more parts from everybody. And plane parts are really complicated. You know, that goes for a lot of businesses, though, but in this particular case with planes, you can't just make, like Apple. They talk about the iPhone X and not making that many and whatever. Their parts in the iPhone X are really scarce. It's all glass. It's a different make of phone. They've got a different kind of screen, the OLED screen. It is a lot of rare stuff in that phone that can't be mass produced in the first place. They never expected to sell 50 million iPhone X's. There's just not that much stuff for them to do. They have to go back to all of their manufacturers and make all these different deals. But Boeing, it's even worse, and Tesla's got the same problem. You know, one of Tesla's major problems in their factory is parts. But all auto companies have that problem. Parts management is the biggest part of the auto business, is managing the supply flow, because you've got 200 different suppliers sending you parts to put together to form a car. And you need them all to be there. For every single car, all 200 parts have to come together and be in the right place at the right time, put into the hands of the right worker who knows how to put that part into the car the right way, and then it has to be checked out and inspected and sent out a thing. It's very complicated. And if you screw up a car part, nobody dies. You screw up a plane part, everyone dies on the plane. So making planes is hard. So one reason Boeing can't just make another factory is that they would have to then have their suppliers make more factories and guarantee they could deliver more stuff, and also then the logistics of the delivery, because right now Boeing has the logistics set up to send everything over to their place in Seattle. If they build another factory and there's no room in Seattle to build another factory, they have to build it in Michigan. They can't just like have parts suddenly flying over to Michigan. It's a complete nightmare. So the board looks at that, and they look at like how much growth do we really expect, and so on and so forth. I mean, all that stuff is an obstacle you can overcome, but only if you really think it's worth overcoming it. And clearly, the board doesn't think so. The board thinks that $9 billion is better spent buying their own stock at this insane price. That's what gets me. What a freaking waste of money. If they thought it was so valuable, where were they here? Where were they? This is only like a year ago at 121. So at 121, they didn't want to buy $9 billion worth of stock. But at 340, they're going to buy at 3 times that price, at triple the price. They're going to buy $9 billion worth of stock. The same stock they could have bought for $3 billion over here. They're going to buy for $9 billion over here. Okay, this is stupid. So I won't play with a company that's being stupid, and this is stupid. That's 1 year ago. So 1 year ago, they were trading at 14, 15, about 13, 14 times earnings. And now they're trading at 40 times earnings. That's crazy. And today, they jump, look, they're down 12. Today, they jumped 20 points. That's even crazier. I don't care what their earnings are. They're not good enough to justify this. They're barely good enough to justify this, which is double last year. That's the 50. Is that the 50 or the 200? That's the 200-day moving average. Is a double last year. I I think they have a hard time justifying that, but let's give them that. But that still makes them 1/3 overpriced. And by the way, this is the problem. This is why you got to be careful of the market, because for the Dow, if Boeing gets realistic and drops 100 points, that one stock will take the Dow down 1,000 points. So at some point, if they turn into a stock that only has a 30 times PE, only 30, they'll cost the Dow 1,000 points, and that's how the indexes are going to fall apart. It doesn't take every stock failing. It doesn't take a negative economy. It just takes certain stocks being repriced, and especially for the S&P, the large caps. It just takes someone to wake up and go, hey, Warren Buffett might die, and why are we paying 30 times Berkshire's earnings? Or Netflix, somebody, well, God forbid, somebody might say, why am I paying 200 times Netflix's earnings? Is there any reason I'm doing this? Amazon, too. Amazon's another amazing thing. Amazon is a monster. We used to try to short Amazon. We gave it up like years ago. It was just insane to short this stock, and it still is. Never changes. Amazon, 962. That's October. That's not even last year. That's October. Last year, $800. Now, almost double. All right? So, if a stock doubles in a year, and the year before was about 500, so you're talking about double and double again over a couple of years. So you've got to imagine that there's some spectacular growth here, right? I mean, I shouldn't even have to look at the financials to see what kind of amazing growth Amazon has. I can just imagine these numbers. So let's take a look. It's going to be so exciting. We go from 88 billion to 107 billion. That's 12, 17. That's like 20% growth there. 107 to 135 is basically 30 points. So you have about 25, 30, 20. Let's even say 30% growth here. So 20% growth, 30% growth. That's very impressive. And negative, got 500 billion, 2.3 billion. This is getting good. So what's going to be this year? 135 and 2.3. So it must be great this year. Let's add it up. We've got, we got 7 plus 3 is 1.2. How are we going to get to 2.3? They're going to have a hell of a Christmas. And you can work that out backwards too. Last year, 2.3 billion. The Christmas quarter was 800 out of that. So it's about 30% of the year. So if we're at 1.2 now, if we wanted to get to 2.4, we'd have to have more than, it would be half the year. So we're probably not going to make the same earnings as last year on Amazon. That's problem number one. Problem number two is this is 70 plus 43. And last year's Christmas, again, not spectacularly larger than the rest of the year. Last year's 43 out of 135. So again, it's about 1/3 of their year. Well, that's consistent. So 1/3 of their year comes in Christmas. But that's not going to make, I don't see how we're going to make it. We're at 70, 110. And so what do we need to get up to? If we want 30% growth, from 130, even 20% growth, let's do the easy math, is 25, so 150, 160, 170, so 110. So we need $50, $60 billion in this quarter. Yeah, I guess that's possible. It makes it about 1/3. So we need at least a $50 billion revenue quarter out of Amazon to keep it at 20% pace. But the point is, that's only to get to a 20% pace. And the earnings, I don't see any way the earnings are going to match it. So what the frick are people paying? Oh, I can't even imagine. Oh my God, $700 billion to make $2 billion. That is it says right there, 373 times earnings. 373 times earnings. It will take them a good 20 years at least to get to a PE in the under 50. This is, I mean, look, they're a great stock. It's a great company, but they're so overpriced. It's completely irrational. Boy, and Jeff Bezos owns like about 15% of that. What a guy. And by the way, it's not like Jeff Bezos' fault. He's not the one. He doesn't go. He's not like Elon Musk. Elon Musk, Tesla is his fault. It's Elon Musk's fault that Tesla is trading at ridiculous prices. Jeff Bezos, no, he just does his job. He's like, I want to build Amazon. He even said to shareholders, he said, I don't care about profits. But they interpreted that to mean, if I wanted to make profits, I'd make them. That's not what he meant. He meant he doesn't care about profits. He sees Amazon as a provider of services at low margins. He doesn't see it as a huge profit maker. He sees it as a reliable provider of services that'll be like the grease behind all the e-commerce, which is great because you don't have to make a lot of money if you're doing all of it. You can make, it's like UPS. They don't have to make a lot of money per package. There's a lot of freaking packages. But Amazon's not UPS. And he's getting into this and he's getting into that. And it's fine because I understand this. It's fun to do all this stuff. He's enjoying himself. And he does have a good way of looking at the world and seeing how things can be done better. And he wants to help. And his healthcare thing is going to be huge. But it's still, he's not doing it to jack up the price. See, when Elon Musk starts selling flamethrowers, he's just trying to create excitement in his stock and get people to buy it and jack up the price. When Bezos goes into healthcare with Warren Buffett and Bill Gates, he's actually trying to solve something. Not Bill Gates, but wait, Buffett and whoever the hell he did it with. He's actually trying to solve a problem and fix the world and make it better. So it's a different situation, but that doesn't. So I just want to make sure divorce that. Like, I'm not anti-Bezos. I'm not even anti-Amazon, but I am anti. This is an insane market cap for the company. Could be the greatest company. Could be Apple. If Apple was trading at 300 times earnings, I tell you, I love Apple, but it's bullshit. And that's the other thing. I'm taking my $700, my $1,400, buying a share of Amazon for 373 times earnings, when I could take my $1,400, buy 10 shares of Apple at 18 times earnings. It blows my freaking mind. It really does. I do not understand the mindset of an investor who buys Amazon over Apple. This is a company that drops 35% of the bottom line. They've got $250 billion in cash. Look at that. Oh, that's a revenue. Sorry. They have a year's revenue in cash. Where's their cash? I don't know if it's going to show up on the sheet, but balance sheet. No, it doesn't show up. It's the overseas stuff that's still coming in. But anyway, even so, they got a couple of $100 billion here. Oh, long-term investments, $200 billion in long-term investments. Money's just all over the place in this company. Incredible, unbelievable amounts of money in this company. And income-wise, this is what they make. That is their profit. Okay, and look, not much growth, but that's their profit. Their revenues are basically flat too, so they're not really jumping up in price either. But 18 times earnings is fair when somebody's pretty static and making good money. And this year they're looking like, they have a good pop here. So figure 80 here. So 50, 100, 150, and 80 is 230 compared to 230. They're flat to last year basically. And how are the profits looking? 11. These are a lot more. 11 and 8. So call this 20. That's almost 9. Call it 20, 30. And, they're not going to make 50. It does not look like they're going to make 50. So they're going to be in line with last year. But still, I'll take it. I'll take in line with last year because it's $48 billion. And I can buy the whole company for $840 billion. So it's 18 times earnings. But 18 times earnings is not really right because you have to take off $250 in cash. So really, it's $600 billion that you're really paying because you buy the company If I buy them for $8.49, I get the piggy bank with $250 billion in cash. So I'm not really buying it for $8.49. I'm buying it for $600. So you buy them for $600. That's how you have to look at it. And then you say, well, now they're making $50 billion a year on $600. That's a PE of 13. That's really what you're paying for with Apple. So I hope they miss or they disappoint and they tank and it goes way down and we can buy a lot more of it, because this is still probably as far as safety and growth and prospects and being a good place to stick your money, still the only stock I'd really want to put half my portfolio into. It's just a huge monster of a company. All right, see if we can do any questions. Okay, can I get the call number? Does the latest earnings make any difference? It's not so much the earnings as the buying back the stock. It's buying their stock for $9 billion. So that's going to give them a 5% earnings boost going forward, and it's going to decrease the number of shares that you're dividing those earnings by. So that gives investors a little bit more confidence. But, so it doesn't mean you should go up, though. You're coughing because of stress. I am not stressed. I honestly don't think I'm stressed. You know what though? Maybe I'm stressed because I worry that I'm going to cough in the webinar. Because I'm not now. See, I'm fine. I don't know. It's been like the last few weeks. I had the flu in New Year's. I came back from Vegas. I had the flu. That wasn't that long ago, though, was it? It was only a month ago. And then for the last couple of weeks, I keep on Wednesdays. I especially get my cough comes back on Wednesdays, which drives me nuts because it's the day I have to talk a lot. You might be right. I mean, maybe I'm just stressing about the fact that that I'm going to be sick again and not get through the webinar again. Anyway, KC 120 on the May contract is looking interesting. Oh, absolutely. Is it 120? Oh, that's a definite. I forgot about my bet. What did I bet? Oh, you guys. Where am I? Oh, I had this one, $55. Yeah, not exciting. But as you see though, this is doing now. It's doing what we thought it was going to do. It's going to go up like that. We're hitting the resistance here, and everyone else is looking okay. But this resistance is going to be key. And like I said, I want to see if we get over that 75 line. But I'm inclined to just take that and run. Mostly because I'm not going to pay attention to it otherwise. But the next one to go for would be if the NASDAQ breaks over 70. Actually, if this guy breaks over this line, which is 33 basically, 28.33, that would be the fresh horse to go by. So let's take this one. It's a nice $85 profit, so we'll take that out. Oh, 80, sorry. All right, so quick $80 while we're waiting, so that's okay. All right, and the next one we want to play is if he goes over 28.33, that's good, but I expect that this will get rejected, and that means everybody will come back down a bit. But not enough, not where I'm going to start playing it short, because I don't think anything happened, and we're close to the Fed, so it's dangerous. So we'll see. Coffee, though. Sorry, coffee has nothing to do with the Fed. KC. Ow. Oh, I see, 122. Where'd you get 120? I would have bought that for sure, 121. I'll buy one here, though. I love them down here. Anytime they're down around here, I can start building a position. What? Why? Oh, it's closed. Oh. Okay, well, hopefully they go lower. Yeah. No, I'll buy coffee anywhere around here. Let's look at the other thingy. Coffee. It's hard to remember what things are. Questions, okay. Coffee. So, as you can see, we did have this horrible spike down to 115, and that's very expensive on the coffee contracts. But generally, this 120 line's been holding, and obviously they make a lot of forays higher. I have an overriding bullish premise on coffee. The overriding bullish premise is that global coffee beans are only grown. Not only they're only grown in certain places, but at certain altitudes in certain places. So generally, they're grown halfway up a mountain between like 1,000 feet and 5,000 feet. It's the only place you can grow them on these mountains in this region, that kind of stuff. It's really crazy. So it's very, very touchy. It only grows in certain places, and it's very easy to disrupt. Global warming, of course, is screwing up the temperatures all over the place. So now, sometimes it's beneficial, but over the long run, no. Over the long run, what it's going to do is it's going to force the coffee growers to move their plantations from one place to the next place, and it takes them 3 years to cultivate working beans, and you can't predict where you're going to go. You just have to find the next mountain where the temperature's right and the climate's right and so on and so forth, and start growing some coffee again. Not only that, though, but the longer, warmer seasons prolong the rust. It's called rust, some kind of coffee fungus. And obviously, the longer it has to have a season, the more it's going to impact the coffee crops. So there's a lot of factors like that. And, of course, people's insatiable growth for the use of coffee. Keurig, the coffee guys, Green Mountain, they used to be Green Mountain Coffee, and now they're Keurig, I think. They bought, they're buying Dr. Pepper. They went private because they weren't making any money, didn't want anyone to know it. And now they're buying Dr. Pepper because the people who bought them privately are freaking out that they're not making any money. And they're going to roll that back into a public company. Since we're paying 30 times earnings or 100 times earnings for things, they're like, well, why not? Now we can get our money back. So clever for them. But meanwhile, the bottom line is, though, that this is another push to get people to use pods. Interesting statistic I found out, though. Apparently, only 15% of Americans use pods for coffee at home, where in Europe it's 60%. I have the European, I have the Lily, not the Lily, sorry, Nespresso. I have the Nespresso, which is European. And I use that one when I make coffee. I can't be bothered with all the grinding and stuff. Tina, my wife, she's a grinder. She likes the fresh coffee. But for me, for my personal use, it's like if she makes it for me, fine, I'll have it. But it's like for my personal consumption, if I want to make coffee, I just stick a little pod in the thing and press the button, and I'm happy. But anyway, point being, very, very low. Even though you see the things everywhere, the reality is most people don't have them. Only 1 out of 6 homes use them. It's really weird. My mother also, she uses it constantly. I thought it was more endemic than it is, but maybe it's only in. It might be a top 10% thing. It's ridiculously expensive. It's a much, much more expensive way to drink coffee. So maybe it's people in the top 10% because that's where I usually see it. All my friends' households and stuff. We're not price sensitive as to whether I'm paying $1 a cup or 10 cents a cup. But I think other people are, and that might be the reason. But I'm not sure what the difference is in Europe and why so many people would rather have the pods. Anyway, so point being that coffee consumption is something that goes up, and it's not like I said, the global warming in some cases can cause plentiful crops, which it did last year, but at some point we're going to have a blight and we're going to have a problem, and there'll be a sharp spike up. I just want to be there when it does, so I keep buying when it's low, and if I get stuck with it, I'm stuck with it. I just keep it for the long term. If it goes way down for some reason, it's not going to stay down. Like people, we consume coffee. It's not like everybody's going to suddenly not drink coffee anymore. So I think the chance of it spiking much higher is way better than the chance of it spiking lower. So I feel comfortable anytime it's down around 120. I want to be buying it. And then now we usually sell it on a really a $3 move, because a $3 move is like $1,000 with coffee. So if it's a $3 move, we'll sell it because that's fine. And then you just wait for the next pullback to do it, or at least sell half or something like that. So I usually like to have two. I'll have 2 to 4 contracts. Like here I'd have 2. If it goes back to 120, I'll kind of work my way up to 4. Then when it goes back to, then when we get the short move, I'll cash out half and see what happens with the other 2, and hopefully let them ride. Because one day I want to catch one of these. We did it. We actually did catch this back in July, which was fantastic. It was like $40,000 or some insane amount of money we made on the coffee contracts. You just got to be there at the right time, and you got to. But also you have to be aware that it can also do this. But the point is, when you're down here, it's a lot more likely to do this than it is to do that. So you want to be in it when it's down here and try to have at least a contract for when it takes off. So that's what I think of coffee. Was that the question? Yes, right. We were trying to buy one and it didn't work. I don't have any sound. Hi, Dennis. Can you hear me now? Somebody tell him like restart his webinar. It's been a little while. Will you briefly explain the Fibonacci lines on your futures chart? I have lines drawn, but they are slightly off, so I want to be sure I'm looking at the same thing. They are not Fibonacci lines. These are what you call pivot points on Thinkorswim. And are you talking about these lines? Either way. Well, no, not either way. These lines are called pivot points. If you right-click on a Thinkorswim chart, there's a thing called studies, and then you, oh no, not studies, sorry, it's a drawing? No, it's a study. Yeah, right, study, add a study, and then you go to trend studies, and then you go to, look at this incredible, look at all these studies. So you go to the P's, and you see down at the bottom of that P list is pivot points. And that's all it is. So it just overlays those studies onto the chart. How's the, you guys don't realize this, I can't see what I'm doing this. Okay, see, we got that little rejection there, so we'll see what happens next. Now, on my chart that I did in the morning, you got to read yesterday's post. I kind of went into explaining the 5% rule a bit yesterday. But my charts, I use what's called the 5% rule, and that's where we're saying that things tend to the indexes tend to move in 5% increments, and from there, you know, the more volume you have, the more trading volume, the more liquid something is, the better to base the 5% rule. So it'll break down to 5%, 2.5%, 1.25%. All those lines matter, but the key is to find the right consolidation line. So that's different. So this is pivot points, and what I do on my charts for my own personal use is I use the 5% rule, which I think is way better than pivot points. But when I see pivot points lining up with my 5% rule, it makes me very happy, and it means that we've definitely got a trade. BA, just trying to manage short covers, just impossible in stock. No, that's crazy. I'm sorry you have short covers. Wow. All right. Well, you know what? When we're in chat, you should let me know what you got, and I'll see if I can think of a way to weasel out of it, because that's not cool. That's a lot. Hi, I am new in options. Okay. What happened? Sorry. Hassan says, I'm new in options. I bought 10 TZA, April 11 calls for 142. I sold the 15 for 41. What is the best way to adjust it? What a great question. So he did the right thing. He bought the April 11, 15 bull call spread. He buys the 11s, sells the 15s. He paid 142 less 40, so he paid net $1. So now let's look at TZA. This is a good way to do his spread. It's a good way to buy your insurance. And let's see how much trouble he got in. Now, I don't know when he bought it, but we'll see what happened. What did you say, the 10, 15s? So the 10s, see now he's not happy because he sees that the net is now 161 minus 30. So it's now what? I bought 10 TZA 11s. Oh, I'm sorry, you bought the 11s. So now it's 110, or let's say 105, because that's the last is 95, but let's split the middle on the bid and ask. So it's 105, and the 15s are 30, or let's say 35. So 105 minus 35 is 70. So his net was $1, and now it's 70. So he's down, and you know, down is 30% down on the position. It is a hedge. And the point is, it's still a valid hedge because TZA is still at 11. You're at the money. And now, how much of a move down in TZA is a 3 times ETF. So for it to move up 30% from 11 to 15 to 14 something, the Russell would drop 10%, and that would put him in the money. So, you know, answer number one is this thing's fine. It just is down at the moment. But these hedges are insurance. If you're making a bet, that's different. But if it's an insurance hedge, that's just what it's supposed to do. You know you're going to lose the money if the market stays up, but hopefully you have bullish positions that offset it. Now, what I would do is salvage the money you have, because you can still pull $1.05 off the table here. That's as much as you paid for the spread, right? By selling these. So you sell the 11s in April. And then you take it and you invest it back into, let's say, the July 10s, which are I would say 190. It's hard to say. These were $2, but this is 160, 212. So about 190. So you pay 80 cents more to move to the tens. So you're dropping $1 in strike, and you're buying yourself 3 more months of protection. Now, you can either leave it and wait for those 15s to expire and then sell a new cover, or there's no real harm in selling another cover. You can get 70 cents for these 15s. So you'd be in the 10-15 spread in July, and it would cost you just it'd be almost about the same money as you're in now. But you would also still have the short April 15, so you'd have to put a stop on them. Maybe, like, say, 50 cents, you put a stop on half, and at 75, put a stop on the rest. So hopefully they expire worthless, but if they don't expire worthless, you stop out. But if you do stop out, all it does is raise your cost from net $1 to net $1.50, $1.70. But meanwhile, you'd be in the money on a wider spread. So there's no real harm in that. So I hope that wasn't too confusing, but you might have to listen to that 3 times on the thing, but that's the way you want to adjust these things. It's the way you play it, is you want to salvage, and it's exactly the right time. Before the price of your long calls falls below the net of the spread, you want to make an adjustment. Unless you have a reason not to, unless you think there's something going on. But if you make that adjustment, you're basically pulling back all the money you put in and making a new trade. But the penalty, there's 2 possibilities then. Either the short April 15s expire worthless, in which case you're in the new trade at a better strike with a wider spread for the same money net, or if it goes up, what's going to happen is you're in a better position. You're in a 10-15 spread in July instead of the 11-14 spread in April, but you will have paid 50% more for it. So, but again, that money you're paying extra is for the extra strike, is for the extra $1 in strike you gain. So it's not a big deal. So in other words, either you're in a better spread for the same price, or you're in a better spread for a slightly more expensive price. But it's very hard to get hurt if you manage it correctly, and that's a great way to hedge. But you have to actively manage it, not passive. Okay, now says Den. Okay, I don't know what. Oh, you're the one that didn't have any sound. That's why. Okay. All right, good. Glad I fixed that. It was the yelling, right? It's like Horton Hears a Who, right? They go, "We are here." Stock buyback at current price. Oh, is it 2? No, not yet. We got the Fed. I forgot about them. Stock buyback at current prices is almost a criminal offense. Yeah, I agree. It should be a criminal offense. In fact, I honestly, in 2008, this is what was going on. They were all buying their own stock at these insane prices, and what a freaking waste! What a destruction of profits went on, because they took all their profits, they bought this worthless freaking stock. It went down 50%, 60% after that. They never should have spent the company's hard-earned money on that stock. It was ridiculous. Like Warren Buffett, he does a buyback. He says, "Here, my stock is worth this." He announces it. He's like, "My stock is worth here, and if it goes below here, I'll buy it. And if it's not below there, we don't want it." So he tells you what his stock is worth. Doesn't stop people from paying way more, but he tells you what it's worth and what he'll buy it for. But it is fantastic if you're coming in when it's going down and you say, "Well, he said it's worth that much. I'm going to buy it." Let's see. Here are the lines calculated on these. How are the lines calculated on these? On the pivot points, oh, don't ask me. Call Thinkorswim customer support. I have no clue what they do, but it works. I'll tell you that, though. They're the most useful. It's the most useful TA I've ever seen, and I hate TA, but it's the only one I actually pay attention to. It's not 120, but you can pick up the options and futures at 124. Nice price. Winston Smith. What is he talking about? I'm so confused. Okay. Oh, I see. You're buying the coffee options on the futures? Yeesh, too much for me. I like that just the contract and get in and out quick. If you only had a modest IRA with no margin account, could you suggest a couple of companies you'd be willing to invest in, perhaps through a bull call spread, or do you think it's wiser to sit out until we get some sort of mean reversion, says Randy. Okay, so If I had an IRA, well, it doesn't stop me from going for bargains. I would buy a bull call spread. All right, so GE, for example, the most hated stock in the universe at the moment. You can buy the $13 calls for $4.75. You can sell the $20 calls. This is 2020 for $165. So what I say, $4.75. $4.75 minus 65 is $4.10. Minus $1 is $3.10. So for $3.10, you can buy the $6 spread. So you will make 100% if GE gets to 20. And your break even is exactly the 16 it is now. So you're not selling puts. You have no margin whatsoever, but you have leverage. And by the way, leverage isn't so you can go crazy and buy some ridiculous amount of stock. It's just so instead of spending $16,000 on 1,000 shares, you spend $3,000 on the spread, and you still have a $4,000 upside. So would you rather have a $4,000 upside on $3,000? Sorry, a $3,000 upside. So in other words, if you spend $16,000 and GE goes to 20, you're going to make 20%. You're going to make $4, which is about a little bit more than 20%. But you have to put $16,000 down. Instead, you can make a smaller investment and diversify more. So with $3,000, you can make the same money pretty much as if GE goes to 20. You're going to make the same $4. Wait, let me make sure I got that right. Now you're getting the 13s for 3, so 16. Oh, you are going to make $4. That's right. So you're going to make the same $4 that somebody buying the stock would make. Wow, that's a great deal. So I'm sorry. So it's a 13.20 spread, which is a $6 spread. No, it's a $7 spread. That's why I keep screwing up. It's a $7 spread. It's not a $6 spread. That's why it works. So you're in a $7 spread for about $3, instead of being in a $16 stock for $16. The same no margin. There's no margin in a bull call spread. That's why I always prefer a bull call spread. GE pays like a teeny tiny dividend now. It's not even worth collecting. So it's like, it's not about the dividend. It's not worth, why would I hold $13 more of my cash in a position when they're not even paying me a reasonable dividend for it? Doesn't make any sense. I'd rather have another stock or more GE, one or the other. So that things like that. There's plenty of companies like that. We feature GE on the weekend, and I want to get to that hopefully, but the Fed's in the way. ABX. And ABX is the other one, Barrick Gold. These are the two top ones I think are really cheap. I'm going to go on TV tonight and talk about these. And Barrick Gold's the same thing. They're basically, well, they're close in price, $14.39. So Barrick Gold, it's the same deal. You buy the, oh no, I'd go with the 13s. So I do the same 13.20 here. This is $3.55. These 20s are $1.45. So $3.55. Well, that's not $3.55. So let's say $3.65 minus $1.45 is $3.20, $2.20. So here you're getting another $7 spread, but this is for $2.20 for a $7 spread. $2.20 for a $7 spread. You're going to triple your money if Barrick Gold goes up. You're in the stock for net $15.20. Not as good as GE. GE, you're in the stock for the same price the stock is. Here you're in the stock for it with the 13s for $15.20, but I wouldn't want to spend the extra money for the 10s. That's why. Well, let's see. Wait. 10.17. The 17s are 2, and the 10s are 5. So you pay $3, but you net in for 13. I'm sorry. I disagree with myself. I would pay that extra money. You know why? Because if you do this, you're in the 10s for $5.50. You sell the 17s for $2 or $2.10. Let's say $2. So that's $3.50. No, $2.20, $3.50. I'm killing myself with this. No, still $3.50 because then you're in for net $13.50 and you still have a really nice upside all the way to 20. No, not to 20. Sorry, to 17. $13.50, oh God. So if you have 100% upside. Yeah. Okay, I can't decide. Either one of those are good though. I'm confident Barrick's going to go much higher. So I think maybe to save the money, the 13.20. But the 10.17 is a little more secure. But either way, it's the same concept. It's no margin. You're going to spend $2.20 or $3.50 to be in a $7 spread. You're paying very little premium yourself, and you just sit there and wait. That's it. Instead of buying the stock, Barrick pays no dividend. So why would you even consider buying the stock? Any stock that doesn't pay a dividend, I would always buy a bull call spread. The only difference is flexibility, because if it suddenly spikes up on a bull call spread, if it suddenly spikes up, you can't just sell it, because your short caller also spikes up, and you might not net out as much money as you wish. That's the only disadvantage to a bull call spread. But when you're talking about putting away one quarter of the cash into the position and getting a not all right, I don't want to say the same upside. If Barrick goes to 40, you still only get your 17, but you can't play like that. You can't play for like, what if I hit the jackpot? No. Realistically, you're hoping it makes a 20% return over 2 years, right? You hope it goes 20%, 30% up. Fine. So if it goes 20 or 30% up, you're going to make 100% on the money you put into it instead of 20 or 30%. Don't play for, well, what if it goes up 100%? That's stupid. Not when you can tremendously diversify and slim down the amount of cash you put in play on these positions. So hopefully that was helpful. Where are we? Okay, CLF getting interesting here. Well, if they're down, they're interesting. I love Cleveland Cliffs. Haven't seen them in a while. Oh, could move the thing. Now it's Fed time, isn't it? Just any minute now. We got to go back to this. All right. Well, I mean, I like Cleveland Cliffs. I think we might have it in one of our portfolios. I don't actually know. Let's see. CLF. No, we don't. Okay, so is it in the LTP? No. Wow. See, I usually have it too. All right. I love CLF. I want to wait for the dust to settle. There's a big drop in iron ore pricing, and CLF is one I like. With Trump's infrastructure thing, you would think they'd be doing better, but they're not. So, wow, 7.27%. So I want to take a look at earnings and see what they look like. Let them finish selling off. They might go back down to 6 or 5, and then definitely get it back into them. Though I do like them in general. Sorry, I'm in trouble getting back to the questions here. Oh, actually, I should stop though and do the other thing. Oh, I missed something. What are the implications of increasing rates for NLY? Can you suggest a trade? Well, Annalie, all the REITs, they think they're going to suffer when rates go up. But if rates go up in a managed fashion, they will just roll over their debt. They know what they're doing. They can take care of it. So it's these panic sell-offs are when you want to jump into the REITs. Winston followed up saying, recent weakness in CLF is quite a decline over the past 5 days. Can't see any specific news. No, I want to look more into it before I jump in. I think it was an LTP trade selling the 2020 $10 puts. On CLF, okay, I don't have it as an official trade, but maybe it is. But I agree. Yeah, I mean, that's a good sell for selling the $10 puts, $4. Anyway, we'll revisit that after. It is Fed time. We want to see what the Fed has to say for themselves. Oh, here's the EIA report. How bad was the EIA? Wait, is this the right one? January 26th, yeah. So there was a net, there's a net build of only a couple million barrels. Oil was up a lot, was up 7 million barrels. Gasoline is down 2 million barrels. Distillates are down 2 million barrels. So it's not that bad, really. 7 here and down 4 here is, I don't know, 3 million barrel build. I don't know why people are freaking out about it. No wonder it went back up so quickly. So not much there, nothing exciting in the numbers. Same kind of exports. Notice exports ticked up a little bit though, and just 200,000 a day. But 200,000 a day is 1.5 million barrels for the week of more exports. So of course it's going to shrink supply. It's all such nonsense. All right, Fed. FOMC meeting, not meeting dates, but the meeting. So the question is this today? What? It's out? Okay. Information market. This is a different format. I don't like it. Is this a big statement or a little statement? No, it's a little statement. Okay. Economic activity rising solid rate. Gains in employment, household spending, business is solid. Unemployment staying low. 12-month basis inflation is food and energy have continued to run below 2%. Market-based measures of inflation compensation have increased in recent months but remain low. Survey measures longer-term inflation expectations little change. Consistent with the mandate, the committee seeks to foster maximum blah, 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 blah. Okay, we know about that. Inflation expected to move up and stabilize. The committee's 2% objective. Near-term risks appear balanced, but the committee is monitoring. Okay, same stuff. In view of realized expected labor market conditions, they decided to maintain the Fed funds rate at 1.25% to 1.5%. The stance of policy remains accommodative, thereby supporting a strong labor market and sustained regrowth. In determining the timing and size of future adjustments, this is the most important part. The range for the fund rate, the committee will assess and realize expectations, conditions, and objectives to maximize. This assessment will take, this says nothing. Wow. Including measures of labor market conditions, indicators, blah, 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 blah. Ugh. The committee will carefully monitor. The committee expects economic conditions will evolve in a manner that will warrant further gradual increases of the Fed funds rate. The Fed's funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. However, the path of the Fed fund rate will depend on economic outlook as formed by the incoming data. Nothing. So it says nothing. I can't believe how little it says. Here's something. Federal Reserve made the following decision to implement monetary policy stance announced by the committee. The governors voted unanimously to maintain interest rates and reserve at 1.5%. Part of the policy decision, the Fed will authorize direct open market Federal Bank of New York until instructed to do otherwise. Execute transactions in the open market in accordance. Okay, I think they're just doing the same thing they always do. They're maintaining the funds rate. They're offering 1.25% to make sure they keep a floor on it. Committee will continue rolling over at auction the principal payments of the holdings maturing each calendar month that exceeds $12 billion in order to reinvest in mortgage-backed securities and the amount of principal payments from the Federal Reserve's holding of agency debt. Mortgage-backed securities each month that exceeds $8 billion. Small deviations from these amounts. So it's just a very, very slow unwinding of the QE, and they're just on track to do the same thing they said they were doing all the time. So I don't really see why that would affect the markets at all, and the markets are unaffected. Nothing. A big nothing. So Trump's speech was a nothing, and this is a nothing. I think we're going to resume selling at some point. Not this second, but I think that's it. I mean, the Fed didn't say anything helpful. Trump didn't say anything helpful, and there's no reason for the markets to go any higher. So expect a pullback at this point. And again, the only reason we're up today is Boeing. This is a Boeing show. Without Boeing, the Dow is negative, and everybody else would be negative too. So that was fun. All right. Back to questions, and then I can't be till 3 o'clock today, guys. I got to run to the TV show. So let me get through these quickly. I'd like to better understand how spread. Wait, this is a big thing. That doesn't help. That's weird. I'd like to better understand how spreads that are already in the money react to a price change like the GNC trade. I have a hard time getting what In the money means and how it reflects on the cost of the spread. If one did the original LTP CLF trade, would you make any money now? I'm confused. Oh, you mean the old LTP? I don't know what it is, so I'm sorry. It's hard for me to give you a good answer on that one. Oh, these are two different questions. I'm sorry, I'm reading it like it's one question. Anyway, all right, Winston, I don't know what the original trade was, and it's better discussed in chat so I could write it out for you later. I better understand how the spread that's already in the money reacts to price changes. GNC, for example, I have a hard time getting what in the money means and how it reflects. Okay, so let's look at GNC. Is it in this portfolio? No, it's not. I keep getting asked things that aren't in the portfolios. It's very confusing for me. That's the long-term portfolio. Let's take a look at the options opportunity portfolio. It's down 5%. That's not good. We got really hit on a Northern Dynasty. That took a big loss. FNSR is a loss right now. But Northern's the one that's really killing us. So like $4,000 loss on Northern. And again, I don't not like it. So that's not really the point. It's fine. It's just a matter of, we have to wait it out now. It didn't go zooming up. Now we're going to have to play it for the long term. But I'm not looking to do anything drastic on it right now. Oh, $1.06. Holy crap. Wait, I changed my mind. What on earth? That went fast. Wow. I didn't know they had such a big drop off today. So weird. Okay, well, my reading of this thing is that the EPA isn't giving them a free pass on this thing. They're still going to have to go through the permitting process, and they're going to have to answer all the objections that the local environmental people have, like protecting the salmon and protecting the water supply and so on and so forth. Now, the question is it even possible for them to mine and protect the water table where they're mining? Maybe, maybe not. But my impression of this EPA is that all you have to do is make a good show pretending that you're going to do it, and they will let them do it. So we'll see. So I'm not inclined to get rid of my Northern Dynasties, even though they are absolutely painful at $4,000 loss. All right, anyhow, that wasn't the question. The question was, which I was looking for, oh, GNC, here we go. Here's GNC. So GNC is not doing anything. So the question was, how a spread that's in the money reacts to your price change. So we have the 250, 750 calls. The problem with the spread for the impatient investor is that we have the 250, 750 spread, and we paid $3.25 for the calls and $1.65 for the short. So it's about $1.60. So we're in for about $1.60, which is net $4.10. So yes, it's in the money. But the problem is that as the stock goes up, these 250 calls will tend to lose premium because they're deep in the money. So they'll get less premium, while the 750 calls, which are getting closer to the money, will gain premium. So even though it's going your way, and even though you're in the money, you won't be showing a profit. You have to wait. If you take a 20/20 spread, you are not really going to see a major improvement in that spread, even if you're in the money, until maybe the middle of 2020, until the middle of 2019. So it can take you 18 months before this spread looks as good as it is. So the thing you have to learn to do is to say, am I on track or off track on this spread? Well, we sold the $5 puts for net 250. So we're in the, so anything over 250 is good on the put side. That's fine. In fact, we're closing on 5 where we make 100% on the short puts. And on the spread, but not now in 2020. And on the spread, we have a $5 spread, and we are $1.70 in the money on the $5 spread. We paid $1.60 for the spread. So there we're fine. We're on target on the spread, and we're on target for the puts. Therefore, we don't worry about it. The premium will have to work itself out. But if this spread does work out, it's 20 times 5. It's $10,000 spread, and we paid 65 minus 25 is 4 minus 33. We paid $700 to be in this spread, and it's a $5,000 spread. I'm sorry, $10,000 spread. So this spread will make $9,300, and all GNC has to do is make it to $750. But at $5, we're still going to get back $5,000 on $700. But the problem is, if this spread goes down $100, it looks terrible because that's 15% down. If it goes down $200, it's 40% down. You start freaking out about it. But honestly, it's only $200. That's the whole point of using this kind of leverage. We're not risking a lot of cash here. We're not putting a lot aside. We're not even using a lot of margin. It's just that the leverage on the ups and downs will drive you crazy. So the best thing to do is to learn not to look at it. And you'll get used to that as you start seeing me comment on these portfolios. We only do a review of the portfolios once a month. We do it about the week of options expiration. So that'll be, oh, not now. Let's see. These options expire on the 16th. So the week of the 16th, on the 12th, 13th, 14th, somewhere around there, we'll be doing a portfolio review and we'll make the changes. But the thing is, we don't make any changes. All I'm going to do is comment on them. I'm going to say exactly what I just said. I'll say this spread was a $700 spread that is on track to make $9,300, but not now in 2 years. But you know what? I don't care when I get 10 times back on my money. Just tell me it's coming, and I'm happy. And that's what you have to understand. It's like these are phenomenal trades. They have incredible leverage. When you hit them right, they pay off a fortune, but not now. It's not a casino. They're not going to pay you 5 seconds later after they spin the little wheel. It takes time for the position to mature. Even FNSR, we have the 17.25 spread, which we bought for $4,100. We sold the $17 puts for $3,100. So we're in this spread for $1,000, and currently it's $1 in the money. $1 in the money is $1,000. We're even on this spread at $18. That's our break even. But options-wise, we're showing a big negative. We're showing minus $4,000. We're showing about $2,000 down. And I'll be talking about this actually when we do the portfolio review. It says it's $2,000 down, but there's nothing wrong with the spread. It's right where it's on track. We're at the money on the spread. We have $1,000. So all it has to do is go up from here, and we make money, and a lot of it, and we only have $1,000 invested. That spread also good for $10,000 if it all goes well. So it's at 17 now. I wouldn't adjust this. There's nothing to adjust. If it goes back to 20, I don't even know what the top of that was. What was the top? Was the 25. If it makes it to 2 years from now, we're talking about what happens 2 years from now. Look what happened here. They went down from where they are now to 10 and then to 30, and now they'll go back down. This business goes up and down all the time, and when it go and you guys will hate it, but if it goes down to 12, I'll buy more. We're at probably around 14. I would start buying more. So I'll put more money into this position. We only put 1,000 in the first place. I'll put more money into this position if it goes to 14. If it goes to 10 or 11 or whatever, I will put more money into it. Unless something drastically bad happened to the company, but I don't think it did. Okay, companies like this, they have a good contract cycle, they have a bad contract cycle, and people freak out and dump them for nothing, for no good reason. And also, if anything happens in the sector, they dump the whole sector. That's why they're great to play, though, because you get these incredible bargains. But you have to be able to, you just have to ride it out. And you do have to learn to ignore those red arrows in your portfolio because, it's down $2,000, but if it expired today, it's not down $2,000. It's $1,000 plus, which is even for us. And meanwhile, if it improves, we'll make $9,000. So I have a 9-to-1 reward. I can make a 9-to-1 reward. I don't think it's going to go lower. And if it does go lower, I'll put, instead of 1,000, I'll put in 2 more thousand, and we'll be in for 3,000, but we'll be in a better spread for $3,000. I don't consider that a negative because it's still going to make $10,000 back at the end. Well, this is only going to make $8,000. So this is only an $8,000 spread, not a $10,000 spread. But you get the idea. Only 8,000. All right, where was I? Questions. How do you think it may go in the headline? No major change in permit process, already down 30%. Yeah, I mean, in any case, bad, and it's going to be a big hole for a while. But I don't want to. I have not yet seen enough reasons to let it go. I think that it's just going to be a long, slow process. You know, it's a shame because if we lucked out, well, it was neat. We played the EPA decision. The decision went against us. It's like when you do a biotech and they fail a study. Just because they fail a study doesn't mean the company's dead. But you have to think about, like, oh, do I really want to be in this thing for like 2 years now and wait? You know, that's where we are with NAK. We're going to be sitting here for a long, long time waiting to get our money back. But the upside on that one also, it's like a 10 bagger if it goes well. What are the implications of increasing the rate for NLY? Okay, I think I said that before. NLY, they can manage the rate and handle it. Is THC affected by the Amazon insurance move? Yeah, everybody is. But realistically, it's going to be years and years and years before those guys do anything and have any kind of effect. So it's way over. Anything down is a way overreaction. I don't know what happened to THC, but. I mean, just because somebody announces they're going to compete with you doesn't mean that your business is over and you should pack it up and go home. And who knows? Maybe they'll sign a deal with Amazon and then they'll go up, then they'll double or whatever. Who knows? But they had a huge run since we picked them up. I'm not really worried about them. They were so undervalued at the time. But you know what? When you see that happening, you should look at the sector stocks that are affected and say, well, who had a big overreaction to this kind of stuff? Because all they're doing right now is forming a private partnership to manage their own healthcare costs. Now, they're big companies, it's a lot of healthcare costs, but they're only forming a little private partnership. If the private partnership works and they're able to effectively manage the cost, already you're talking about 2 years to set it up, a couple of years to test it, you're talking about 5 years from now before this is even a thing that would affect other companies. Then they would maybe want to market it or roll it out or figure out a way to do it with other companies. But that's 5 years from now. What does that have to do with THC's price today? Again, if it was Amazon, I would be worried because I have to make 300 times earnings in 5 years to justify the price. But with Tenet, no, they're priced at like 12 times earnings. So I'm not too worried about them making their money in 5 years. GE 2813 calls don't look right. Is your screen refreshed? My screen shows the 13s at 475. I don't know. I mean, I'm just using the screen I got. GE 13 calls. Oh, wow. Oh, is these 13 calls? June. Ha, ha, ha. My bad. I guess we were looking at those. So the 13 calls in GE are 475. I thought that's what we said, though. And the 20s are 175. So that's $3 on a $7 spread. I swear that's what we said. Oh, no, wait. I'm sorry. No, that's right. It's 475 or 485 was the last trade, and 165. So 165, 485 is 25, and three and a quarter. It nets 3 and a quarter. Is that maybe that's why? Because I said the net, and you probably thought that I said that was the price of the 13 calls. It's the price of the 13.20 spread, not the $13 calls. I missed the CMG play. Would you accept a position at the highest strikes? No. You know what's with CMG? We got a great price and we're going to stick with it. But the problem with CMG is that there's like a site now. It's a manipulated stock. It's completely manipulated by people who have figured out that all they have to do is drop rumors on the internet, not the internet, on the social media. Well, I guess that is the internet. All they have to do is drop a rumor that somebody got poisoned. And by the way, this is the point I made back in the old days. When CMG dropped really badly, like a while ago, they were like 260 or some crazy low price. The point I made to people, and we ran the numbers. I did research. I looked it up and blah, blah, blah. I don't remember the numbers, but an incredibly large amount of numbers, a number that you would be very shocked at. People get some kind of food poisoning every day, like millions, like, not millions. I mean, it's every month, it's millions of people, though. That's what it was. So obviously, since it turns out that like 10% of the population of the United States eats at CMG once a week. Same goes for McDonald's, by the way. But the thing about McDonald's is they are so CMG is into fresh food, so their food is more likely to give you some kind of food poisoning because it's fresh. It could have a bug, could have this, could have that. It's much more likely. Everything at McDonald's is dead. Everything you eat at McDonald's has been thoroughly killed before it gets to you, including the vegetables. So there's like basically zero chance the way McDonald's does things that you can get sick from their food. And that's because Jack in the Box, killed people in the East Coast once, and that's why Jack in the Box isn't in the East Coast. When I was a kid, Jack in the Box was like deadly, and people had food poisoning and things, and some people had died, and the company just basically retreated from the East Coast, which is a shame because I used to love going to see them. When I was a kid, I used to love it with a little clown that would take your order and stuff like that. So bottom line, but Chipotle now, there's an actual website that tracks and encourages anybody who's sick to check and say, have you been to Chipotle? Did you get sick? Report it here, blah, blah, blah. They are, because it's the easiest short in the world. When these guys get a short on their site and they get a hit, they plow it through the social media and they short the stock, and it goes down $5 or $10. You can make thousands. You can make 100,000 on the stock shorting it. And it's legal. There's nothing illegal about it. They found out that somebody got food poisoning. They make sure everybody knows someone got food poisoning, and they collect the money. So it's a crazy stock. And so if there's an outbreak in a store and hundreds of people get sick, that's one thing. But when one person gets food poisoning in the United States, that doesn't mean there's anything wrong with the restaurant. You can't even be sure it's them. That's the other problem. It's like you have a stomach virus, and they say, where did you eat this week? Did you eat at Chipotle? And again, 1 out of 10 people who have a stomach virus are going to say yes, because 1 out of 10 people eats at Chipotle once a week. So it makes no sense. The whole thing is ridiculous. But people have no sense of proportion, and it's so easy to scare people into this kind of crap. Let's see. Pfizer. Naomi says Pfizer. Oh, wow, there's more. Good gosh, I can't do this, guys. We have 337 bull call spread goes to ex-dividend 2-2. Any trading slightly higher? You mean because the stock's above it? All right, you're going to have to ask me that in chat, because that's just a whole big adjustment thing. PFE. The quick story on that is they're at 37. You're not going to get called away on the 37 calls because 1-2019. Because those calls are much more money than the dividend. I know the dividend is like 30 cents, 40 cents, whatever it is, or 50 cents, even if it's 60 cents, it doesn't matter. These 30 calls, what? Wait a minute. 37, sorry. The 37 calls are $2.50. So you're not going to get called away. They're not going to exercise those contracts to steal your dividend. So don't worry about it. You have it, the $10 puts you scroll past. Now I got to go back and figure out what that means. Would you make any adjustments to Cliff? No, if we just sold the $10 puts, I wouldn't make any adjustment. I do want to own them for net 6, even if they are net 6 now or even lower. Who cares? They're 6. They're 7. So I think the net was like $6, and why would I want to change that? So I'm fine with that price. Even if it goes to 5, if it goes to 4, what do I care? I get in for net 6, and then I buy more at 4, and I average 5. It's no big deal. And if I average 5 and I sell the $5 calls for $2, I average 3. See, this is the thing. When you think about all the adjustments you can make, why would you panic? Right? Because here's the thing. We sold the $10 puts, which is still $3. We sold them for like $4, I think. And they're at $6-7 now. Okay, the stock. But if the stock goes to 5, all that happens is I get assigned at 10. Oh, this is March. This isn't even sorry. These $10 puts are $4. The 2020s. So the stock is at 7. We have a net 6 entry if we get assigned. So if we get assigned at net 6, even if it's at 4, all I'm going to do is buy more 4s. Right? So the stock goes to 4. I get assigned at 6. Now I'm in 1x for 6, and I then buy another 1x for 4. So now my average is 5. I sell the $5 calls, which are now $3.70. Maybe for this price, maybe for the price of the 7s at $2.35. So my net drops from 5 on 2x to $3 on 2x, and I get called away at 5 with a $2 profit, which is 66%. So that's my worst case scenario. It's not my worst case. They could go bankrupt. But in other words, why? So if that's where I'm going to be, if I'm going to be $3, I would actually love to have 2x of Cleveland Cliffs at $3 and be called away at 5 when the stock is currently at 7. So you guys worry too much about these little things when they change. It's like that's when we, if it really goes down, that's when we shine. That's when we really want to add to a position or change it, assuming, of course, we don't hate the company all of a sudden. But these little things, they're up and down 20%. Who cares? It's not a big deal. That's going to happen. With options, it's always going to happen. You're always going to have these violent moves up and down. You just have to say, am I on track? Do I have a realistic expectation that the stock is going to expire at that spot down the road? And if you do, then you don't worry about it. What time is it? 25 after? Okay. Oh my God, the Dow's dropping, huh? Let's see. There's some big tech, blah, blah, blah. If they raise their guidance, will the markets continue to sell off? I think it's all priced in. I really do. All these guys are just so overpriced. This is Lerner saying there are some big tech bellwether earnings on their way, Amazon, Apple, blah, blah, blah. If they raise guidance, will the market continue to sell off? Look, even they have to raise guidance a lot because we're up a lot. And these stocks are up incredible. Like Amazon, like what did we just say? Some insane amount, whatever it is. It doesn't matter. They're up much more than they can possibly earn. So, Amazon, their market cap is up $200 billion. And maybe, let's say they blow everybody out of the water and earn $1 billion more than people thought. You're still paying 200 times earnings for that incremental $1 billion above what you paid last time on the last earnings report. That makes no sense. So, the markets will sell off until the markets will, I don't want to say sell off. The markets will at some point reach a more rational valuation, and that valuation is lower than it is today. So whether it's a sudden sell-off or whether it's a gradual sell-off or whether we stay flat for 5 years until the earnings actually catch up to reality, one of those things is going to happen. But bullish, I'm not. Not in the intermediate term because we're just too far ahead of ourselves. Cliff is at the top of the. Okay, so it's just a $10 put. That's why I didn't see it. So for GNC, the expiration we need is to be at 750 to make the full gain. Correct. To make the full gain, you need 750, but your break even is, I forget, 850 or something like that. So, it's not about that. You have to just say, okay, at 850, I make $1,000. At 950, I get $2,000. At $10, I make or whatever it is, I make the full amount. But that's all it is, and you're on track. So are you on track? Are you making the progress towards your goal that you want to make? So I'm sorry, 7 or whatever the break even is. I'm sorry, so 750 is the top. So let's say 550, 650, whatever the number is. The point is that you just want to say, you can even graph it out. You can even say, look, between now and 2020, I want to make $3. So therefore, every month I expect to, since we have there's 20 months to go, I expect to make 15 cents a month. And if you're making 15 cents a month, you're on track. But that's all you should expect out of the trade. Don't, even if it jumps up, it's not going to jump up. You're not going to see it reflected because you have the spread. And sure, you made money on your calls, but so did the short call you sold to. So you just have to be patient and wait for his premium to wear off, and then you collect your full amount. So for GNC at expiration, we need to be at 750. Oh, sorry. Phil, you partly respond to my NLY, but can you suggest a trade? No, I cannot. We're going to do that tomorrow. so remind me tomorrow in chat, and we'll do a trade on NLY because I think it's too early today. And again, the reason I said right before we started the thing, I said it's too early because the Boeing was the whole reason the Dow was up. The Fed didn't say anything supportive of the markets, and we're probably going to keep selling down. So why would you, you don't want to jump on a falling knife. So NLY, much as I love it, I'm not in a hurry to buy it. I don't have an emergency. And look at them. They're down at 1050. And that's an ugly, ugly chart. And look at where they are still. They've been much uglier. They can go to 950. They can go 9. There's nothing says they're going to stop here. There is some support here. There's certainly support around 960. But let them do what they do. They're not likely to bounce right back up because the policies aren't going to change and the interest isn't changing. The Fed didn't announce any kind of change that's going to help them. So it's just a question of waiting, and we'll see. I don't care if I end up buying them at 11. That's not a big deal. You know, if I go, oh, I wish I bought a 1050. So what? The thing is, if it goes to 9 or it goes to 8. I mean, look at Finsar now, and look at NAK. It's like, there's no harm in waiting sometimes, because things get cheaper. Some things get cheaper, some things get more expensive. Buy the ones that get cheaper. So we'll see what happens with those. God, you made me laugh at the honest quote. Okay, well, thanks. I'd like to better understand a spread that is already in the money and the price change. Oh, you said that already. That was I guess that's in a funny place. Okay, I have to wrap this up because I got to run to the city and be on TV. Oh, damn it. Okay, hang on. Sorry, I forgot about this. This is what I'm going to be on TV for. So here's your homework assignment. Money talk, right? Money talk. On the weekend, and this is, by the way, it's a top trade alert, so I'll show you the top trades. See, it says money talk portfolio. Not hiding. I sent this out. I even tweeted this on the weekend, I think. So there's that. We always have a portfolio called Money Talk. It's philstockworld.com Money Talk. This is for this specific show that I go on, and I go on maybe once a quarter, and we only make the adjustments once a quarter if we make adjustments at all. Didn't really make any adjustments last year. We picked up Apple in wait, sorry. We picked up Wheaton Precious Metal was our trade of the year, so that was our first trade in the portfolio. Didn't make another trade until September, because I was on one time in between, and we didn't have any trades that time for whatever reason. So we only made one trade in the beginning of the year. Then in September we made 3 more trades. In fact, I specifically went on and said we should make some more trades. So as of September 6th, we were only up 15%. Then on September 20th, we were up 18%. On November 9th, we went up 61%, which is cool. And December 12th, 78%. And now, at last reading, well, 74%, but that's from January 28th. But the reality is, I think we're down a bit from that. 70%. Okay, not so bad. So after a rough week, we're at 70%. So it's holding up okay. Where was that? There. Anyhow, so now I've got adjustments though. So basically, either here or in that top trade alert, you can see these adjustments, but you have to scroll down to the right one. Always, when you look in the Money Talk portfolio, make sure you get the date, because I keep adding to it, so we have the history of what we're doing. So I went over a big detailed thing. I'm sorry, because I wanted to go over this. We all right. I can spend 10 minutes on this, and then we got to go. So no more questions. All right, calm it down. Good. All right. I got to get out of here. I got to start getting ready. If I hit the rush hour traffic, it's going to take me like 3 hours to get to New York. And then I'll be all stressed out, and I won't do good on the interview, and blah, blah, blah. All right, so here's how we do our reviews. Apple. It's a $30,000 spread that cost us $6,100 in cash. Currently, it's at $13,550, so we're up double so far, but that doesn't. It's up double, but our goal is to make another $16,000. So even though it's net 13 from here, $13,550, we expect it to go to make another $16,000. So and Apple's down, in fact, so it's probably cheaper right now. So we're already up. So we're up 122% so far. We have from this total, we have another 100% to gain. 16,000 from 16 is 300% more from 16. So the thing from 61. So the thing is so again, it's like the other one we were talking about. There's so much leverage on these spreads that it seems like incredible. You're like, whoa, we're up 122%. We should take it on the table. But you have to keep it in perspective. We're just on track. This is a very mellow 150, 155, 165 bull call spread. And so the question is, by January of this year, do we expect Apple to be above 165? And if we do, nothing to worry about. Then we're going to make another $16,000. So frankly, after earnings, if Apple is down, this is still good as a new trade. I don't think I'd jump in there right now because they might go down before earnings. But if they're down before earnings or even flat, this is good for a new trade for sure. IMAX we made adjustments to because IMAX is the only one that's off track a bit. and not too bad. The damage to IMAX is negligible, or in fact, actually, I'm sorry, there's a small profit in the IMAX trade, so it's not even damage, but I'm not satisfied with it, so we made an adjustment. But again, this is how we do our reviews. We say, here's how much we put into it, here's how much we're going to put into an adjustment, here's where we expect our gains to be. That way, in every position, and you should do this with your portfolios, every position in your portfolio, you should know how much money did I spend on it, how much margin is it tying up, that's good to know too, and how much money am I expecting to make out of it, because you need to know whether or not it's worth keeping each position. And you're not going to know that if you don't have it written out. And another reason to write it out is so that you know what you were thinking and what you expected, and whether you're on track or off track for your expectations. So LB was our trade of the year. It's net $21.50. It's up $17,000 from our $3,400 outlay 4 months ago, because we did it in September. It was perfect, right? We hit the dead bottom here. That's why, as of September, it was going to be our trade of the year. But then, unfortunately, by November, it had already jumped up 30%. So we went with Hainesgrand instead, officially, for the trade of the year. But for the Money Tour people, I was on in September. I said, this is our trade of the year. So unfortunately, it wasn't officially our trade of the year, but I love this stock. This is, Victoria's Secret people. The maximum payout is, so I said, we're at 21,000. The maximum payout is 30,000, and all LB has to do is stay over 40. Way down there. And it's a 2019 spread. It's not a 2020 spread, I don't think. Hang on. It is a 2019 spread. So we only have to wait 12 months to make 50% more money on this spread. I'm not worried about it enough to take it off the table. I just sit here and we're going to make I'm going to make $8,950 in 12 months from 17. I don't particularly have anything better to do with $17,000 than make 50%. I mean, we could risk it. We could find other things, but this is a very safe 50%. So why would I change it? Wheaton Precious Metals, another one we consider very safe. Now this one is interesting. We've gained $11,000 so far, but it's going to gain another $13,000 at 22. Now it's not at 22, but the point is we expect it to stay in this uptrending range. And again, this is for the end of this year. So we're going to make another 100% this year on the money that we already have, which is so far up 585% from the original money. So that's what I mean by on track. We look at the positions, and they're never going to look like that the first month. But after a little while, and these are only September trades mostly, you see that they're on track, they're going well, you don't need to adjust them, and you just leave them alone and let them make their money. It's a wonderful way to trade. So then, most importantly, though, I added a hedge on SQQQ. That so far hasn't moved, so it's fine. You can still do it. See this? We expect to lose money on this trade. It's a $2,300 trade that we expect to lose money on. Okay, it's giving us $26,000 of protection for the portfolio. That's half. It was only a $50,000 portfolio, so we're getting half of the total portfolio in protection. So that's what, from where we started. So we're making sure, like in worst case scenario, if the world collapses, we're still going to have $2,600. We'll still have half our money. Probably it won't, and we'll retrieve some value from our stocks, and we'll get back to 50,000 or maybe more than 50,000, even if the thing falls apart completely. But that's what a hedge is for. It's insurance in case things go wrong, and for some reason we aren't able to even extract any value from the trades that we have. And it's like, this is like life insurance. You don't want to win. You're going to pay it every month, but you don't wake up every morning and go, oh man, it's like, damn it, I'm alive again. I can't believe what a waste that was. That's what this is. It pays off unless it pays off if the market goes down. If the market doesn't go down, our longs pay off. How much do they pay off? I know exactly what they pay off because I wrote it all down here. In fact, I said that somewhere. We made $36,000 in year one. We have $44,510 worth of gains to be expected if the market stays up from here. So unless the market goes down, we're going to make $44,000 more dollars. Now, obviously, assuming no specific stock we have sucks and falls apart, like NAK. Like if something suddenly happens and somebody falls apart, that would blow it. But all things being equal, we expect to make $44,000 unless the market goes down. Therefore, if we're going to lose $2,300 to protect it, that's a great deal. Now, in this case, we offset the bearish spread with this SQQs. We offset it with a bullish play on Alaska Airlines because I freaking love Alaska Airlines at this price. That's a ridiculous price for that. So it's a good way to offset the cost. But you can pick any stock that you really would like to own. You can do something similar with the short puts. It doesn't have to be Alaska. I just like it. We don't have an airline. We don't have any transport, so it was a good thing to have a transport. And the amount of money it pays due to the recent volatility is crazy. Because you're netting into the stock for like $51.80, which is nuts. It's currently around 65. And then, of course, GE, which we just talked about. And here we did the 15.22. So I was actually more aggressive on GE. I picked the 15.22 spread, $7 spread. Our net cost on this one is $3,050 because we're doing 20 of the longs and 10 of the shorts. But I went fairly aggressive with the puts and sold the 15 puts. It's $3,050 cash. And the spread will make... the spread will pay back $14,000, 20 times 7 will make $14,000 for a gain of $10,950. So 300% plus side, 359% return on cash. And our worst case scenario is we own GE. It's not a terrible worst case scenario. And that's the same thing as the GNC. So what? If they drop to $10, I'm going to be forced to own 1,000 shares at 18, 15 plus the 3,000 we have here. So our worst, and again, that's assuming the spread is completely wiped out and we can't even salvage $1 out of it. Because if we could salvage $1 out of it, that'd be $2,000 less dollars. But let's assume that we're completely wiped out and and GE's at 10 and we're paying 18 for the stock, which is $15 times 1,000 plus 3,000 cash. So we're at it for $18. That's our worst case. And the stock's at 10. All right, so what do? I buy more stock at 10, and that's going to be an average of $14. And don't forget the stock's at 10. So let's look at GE. Now here's where it's kind of speculative, but I mean, trust me, I do this a lot. So GE is at 14. And now it's at 16, and I can sell the 2016 calls for, there are no 16 calls. I can sell the 18 calls for $225. All right, there's a good example. I can sell the 18 calls for $225. So if GE drops to 10, since I can sell $2 out of the money calls for $2 now, probably I can sell the 13 calls for about $2. So don't forget what we're doing. That we get the stock assigned at 18, and again, that's ridiculous because it means our spread would have gone worthless and we wouldn't have done anything about it. We would double down at 10, so our average is 14. Then we just take the stock we have and sell the $13 puts for $2, and our average goes from $14 to 12. So now we're called away at 13 with $1 profit. Not exciting, but of course we can sell puts against that too. But just even just saying pull back and get into a shell like a scared turtle and just try to defend the position, our worst case there is that we would then double down at 10, again, assuming they're not going bankrupt, but we double down at 10, we sell the $13 calls for $2. Now our average is $13, our average is $14. The call away would be about 15. But that's only the first step, because then the next year, if we don't get called away, and first of all, we start collecting the dividend if there's still a dividend. But even if we don't get called away, or even if it's a little bit above, we can then roll the puts and roll the calls, sell some puts, do whatever, and start playing it more bullishly. And don't forget, when your base is down at 14, if you make $1 or $2 every year selling calls, you're getting a great return. And I'd love to own GE at $13 a share and for the rest of my life sell $1 worth of call, even $1 worth of calls every year against my $13 position. And I'm getting 8% plus a couple of percent dividend is 10% coupons from GE every single year for the rest of my life. That's not a bad position. And all we're doing is setting up for that possibility. If it doesn't work that way, we'll just make the money on the spread, which is $10,000. So if it goes up, we'll make $10,000 and be done with it. And if it goes down, we'll make we'll have 2x, which is 40. So we'll have 4,000 shares. And let's say we only make $1 a year. Instead of making 10,000 one time, we'll make 4,000 a year forever. And again, unless they go bankrupt on us. But the chance of not being able to sell $1 worth of calls every single year against GE is infinitesimal. I mean, hell, you can do that. You can do that with GNC, and they're priced half as much as GE. You can make $1 a year. So that's what these trades are all about. Our fallback position is not that bad. Our front position is making 359%. So if it goes well, we make 359%. If it goes badly, we're going to make 20% a year. That's the way these are set up. But the problem is, especially for you new guys who haven't done this before, because we've been doing this for a decade. I've been teaching this to people for over 10 years now. The problem is if you're just first seeing a portfolio brand new and you're used to these quickie ins and outs and all this stuff, it's very hard to get used to the pacing and the timing of these things. It's just you gotta go with the flow over time. That's the problem with it. Unfortunately, I wish there was a faster way to do it. You can, of course, go back to all of our old portfolios in the portfolio section on Phil Stock World, which is what happened? You can go to the portfolio section and you can go back to really, really old portfolios and you can see, just go back and back and back. That's when we first crossed $1 million. So you can see all of our top trade reviews, our portfolio reviews. They go back, it's 2014, 2013, that's when we started our portfolios. 2012, okay? So you have a full decade, basically, of old portfolios that show you exactly how we buy things, how we talk about them, what we decide to trade. These are all of the decisions we've made for the last decade in our portfolios. So if you want to see it quicker than waiting for the ones you've got to do something, go back and review the old stuff. I strongly encourage that. Okay, I gotta go. Gotta run and do my TV thing. Futures are diving. Oh, don't do that to me. Let me see. Oh, man. And we didn't short. Oh, well. What a shame. Well, we did short because we have our hedges. Wow, that's ugly. Okay, well, like I said, though, it's not a surprise. It's like we thought it was going to go down. All right, so here you go. See, the NASDAQ is way behind. That's where these things are great. See this? He broke his support here. He's down at his support here. The Dow's failing his support here, and the NASDAQ is only just failing now. So if you want to play a short, you can play the NASDAQ short, and then with a stop, you have a very easy stop line here at 69.50 or 69.48. So let's do that officially, just to close this thing out so we have some fun. We're going to go to Active Trader. Oops, sorry, wrong one. Active Trader, here's the NASDAQ. And we just go sell. Oh, you bastard. Just go sell. And it doesn't take it. There it goes. So now I got one short at 69.41. And my stop would be at 69.50. Now, I'm also going to look for a long, though, at the same time. What's missing? TF? I want to see if anybody looks good for a long. So if he goes over 75, I would play it for a long also, because we're not sure which way it's going to go right now. But this is an ugly sell-off, and I think we're going to have some severe follow-through. So I do want to have something short over here. But I'll play this one to 40. I'll play this one up to 50, which is going to be a loss of $980. So I could lose $180 at this line. But otherwise, I'm thinking, and I said this yesterday, I said we could have another 600-point drop. And I warned people about this yesterday afternoon, and Boeing screwed it up. But I think that now that that's over, I think that the big sellers are going to come back and start pushing it down again. But we'll see what happens. All right, I got to go. Sorry I can't follow through on the futures. Everybody have a lovely day, and we'll pick this up again next week and see how we're doing. All right? Thanks, everybody. Take care.